You're all about small caps. I'm looking at the numbers. Russell down 1.8% over the last week, deeply underperforming the other indices. These stocks often seen as the most interest rate sensitive. Looking at the 10-year at its highest level since October. Why small caps now?
So first, it's a valuation story. And look, you can be cynical about it. If you don't have performance, you have valuation. But it has been over a decade of underperformance. The Russell 2 is trading at 50 cents on the dollar to large cap stocks. But your concerns are warranted because when you go down into small caps, quality degrades, leverage goes up, interest rate sensitivity. For us, the solution, and you know I'm the guy who comes with applications of dividend growth to places you might not expect it. You can apply that dividend growth screen to small cap stocks and resolve some of those quality issues, but access that discount.
All right, so you're leading us in a direction, so I have to ask you, what's your WEX word of the day?
So the WEX word of the day is small cap dividends. I always sneak in two words.
That's a phrase.
It's a phrase. It's almost a phrase, but the hyphen makes it only two words. When you go into small cap stocks and you screen for dividend growth like we do in SMDV, ProShares Russell 2000 dividend growers, you resolve many of those issues. And if you want to see a stark place to see that, look to earnings season. To your point, the Russell 2000 writ large shrank earnings 26% year over year. But the Russell 2000 dividend growers grew earnings last earnings season 21%.
So just to be clear, your thesis here is that what you don't get from price action, you get from dividends.
Correct.
Okay.
But you also should be able to get some price action because of that earnings growth.
All right, so your pick for us today, you just mentioned it, ticker SMDV. It's a small cap dividend fund. Give us a sense of the holdings in there, the top holdings, and what you're buying when you buy this ETF. And is this a move you would just do today? Would you do this today?
So a couple of pieces. One, there are no top holdings, so it's an equally weighted strategy, which is a really important way to think about it, particularly in this environment where we're worried about top heaviness or even a portfolio that's skewed. So it's an equally weighted strategy. And indeed, for many folks who probably have kind of ignored small caps for a long time, and they were right on that trade, it belongs in a well-diversified asset allocation.
Yeah, we're looking at the chart right here, down 0.5% year to date, closed lower yesterday. So if this is a smart play, why aren't investors running to this yesterday? Why did it close down 1.5%?
Well, the issue is that top-driven market. Folks have just not been looking at it, and it's paid off in the era of free money. So with those technology names starting to pull back a little bit, the breadth beginning to expand in the market, our suggestion is don't stop looking for that breadth just at the other 493 names in the S&P 500. Look beyond large caps.
All right. I know you're also focused on yields. How do you see yields impacting the market today? Just taking a look a minute ago, 10-year at 4.18, yesterday even higher, highest level since October. We got to remember, we saw a big sell-off in October, November, and December last year.
Super important stuff here. We had strong retail sales this week, and that's coming on the back of lots of better news for the economy than folks would have expected. But CPI, PPI looked good. What you see in the yield curve is an appropriate reaction to that. And that is, yes, a little bit of rise in short-term yields. Maybe the Fed will stay higher for longer, but a steepening, or at least a less of an inversion, because the 10-year's gone up a lot more than the 2-year. We think that's getting to a stable place. We're about 2% real yields on the 10-year. So don't expect any further either increases in rates or decreases. We think we're at that long-term equilibrium. But by the way, that means that PE multiples, don't expect great expansion there. It's got to come from earnings.
All right, so you believe that we've hit the peak when it comes to the 10-year?
Stability.
Okay.
In other words, the long-term average of the 10-year yield
is going to stay around this level.
2% real and 2% inflation. So maybe we have 2.5 to 3% inflation. Maybe we get to 4.5 or so on the 10-year. But that should be a pretty comfortable place, even, and this is important, even as the Fed cuts. Because when the Fed cuts, don't expect the 10-year to rally. Very important.
All right, understood. I want to shift you beyond just the U.S. markets to global. We got that read on Eurozone GDP. Kind of a mixed reaction from Europe last time we took a quick check. What do you think that means? What does that say about the global economy for Eurozone GDP to show not only sequential growth, but 0.6% growth year over year?
We're back to the sort of cynical but truthful story. Those things that haven't been performed are inexpensive. We know that Europe, similar to small caps in the U.S., are trading at roughly 50 cents on the dollar to the S&P 500. Now, You can't get that excited about it because the long-term average is a 30% discount.
Right.
50% is better than 30, but don't think that it's so dirt cheap. But if I had to make a choice, I'd rather bet on the small caps at 50 cents on the dollar than Europe at 50 cents on the dollar for a little while longer.
So you're not feeling that great about the international markets right now, you're saying. So is it go beyond the Eurozone, or you're saying just the U.S. markets in your mind are the place to be? Because we have a lot of guests coming on and say there's a lot of opportunity in international markets that have either underperformed or have actually outperformed but have more room to run.
I think you just have a little more time. Sadly, the war in Ukraine's not over. And of course, the weakness in China that we've all been talking about this week may have a little bit more of an impact on Europe than it does in the U.S. So I think you just have a little bit more time to access that discount that is clearly there, even in developed international markets.
You know, you're leading me to my next question. China coming out saying that they believe they're going to miss their 5% growth target for GDP for the year. Does that impact any parts of the U.S. market specifically? I mean, maybe industrials, maybe tech. Is there an impact that you expect to see kind of play out today and throughout this week?
I think it's not going to be a big deal. Historically, there hasn't been a huge impact. Look, China's obviously bigger than it was 10 or 15 or 20 years ago, so we can't completely ignore weakness there. But we have never really seen weakness in the U.S. be precipitated by weakness in, frankly, any other country around the world.
I want to come full circle. Your pick for us today, the SMDV ETF. It's a small cap dividend fund, really focused on dividends out of small caps, equal weighted, which is interesting. We're hearing a lot more about equal weighted. So in general, right now, is this the time to kind of go in and buy the dip on dividend stocks and dividend funds that have been underperforming?
Well, they've actually started to perform again. So, but indeed, look, this is an all-weather strategy. That's the important part. You see so many people taking the valuation of the S&P 500 and they say, well, it's 20 times, so that's a 5% yield, and the Treasury is at 5%. Oh my God, that's bad. Well, yeah, if the stocks aren't growing their earnings and dividends, that's bad. But the whole point is to seek out growth. So rather than flip all the way to deep value that might not grow, if you buy a stock that's not growing, you might as well be a bond. We think that the dividend growers are a real important place to be because of that growth.